I want to thank everyone for being here today. We are really excited about having our third installment of Financial Wellness, a healthy approach to money matters with Lori Nadglowski, who is with us with Laurel Wealth. If you need some more information, please check out our website at hcplc.org for this or lots of other programs that will be coming up. And if you're watching this course live, please remember that in the side panel, there is a place for you to chat. We will answer those questions at the end. So we can, if there's something burning, we'll answer it during the seminar, but afterwards we'll try to get Lori to answer it. And then lastly, at the very end, we really want to hear your thoughts and how you felt about the series, and also what we can do differently in the future. So there's going to be a survey. Please make sure you fill that out. But right now, I just want to say thank you for joining us. And Lori, I'm going to turn it right over to you.
Great. Well, thank you very much. I want to thank everyone from the library for allowing me to give my presentation on financial wellness. And this is the last of the three-part series. I'm going to spend a couple minutes and I'm going to go over what we covered in the first two. Part one was on identifying where you are today. Part two was on budgeting when cash flows may not be certain. And today's part three, and I'm calling it the recovery, but this is really financial wellness, going forward for the rest of your life, how to get into a healthy financial position so that you can weather some of the storms like COVID, or it could be unemployment, or it could be, something else that happens in your life, to be able to be prepared to be able to handle some short-term unemployment. So I'll review week one. In week one, we were looking at, well, where are you today? What resources do you have to fund your goals? And for now, your goals are going to be trying to get through the next, 60 days or the next year. What do you have? What is your income? What sources of income do you have? Is it from a job, a primary job? Is there another type of job that you can have? Do you have income maybe from an employment? It could be from a severance package. There's a variety of different places. Social Security is another place for income might come in. Assets, what do you own? And when we looked at assets, we're looking at what can be converted to cash quickly. It could be your checking account. That's going to be your primary asset, the easiest way to have cash. It could be your savings accounts, your investment accounts, your retirement accounts are also an asset that can go into there. And then any other asset that you might have available that you would want to convert to cash. That could be something that you might have that you could sell easily. And then finally, the expenses. What do you owe, or what do you need to pay? What's important over the next 60 days, or what is your annual budget? And the easiest way for that was to go back and look at some of your bank statements and your credit card statements. If you use your credit cards regularly, where are you spending money? And coming up with categorizing those expenses. So week two is where we actually built the budget, and I will share back to the budget with you. Let me make sure I'm sharing my screen. Okay, so this is the budget that we looked at, and this is one that I use when I'm working on financial planning clients. It's about coming up with where you're spending your money. We looked at the income first, and so I think the income's on here, but these are some of the expenses, and we talked about expenses that are necessary. So it's going to be the home expenses, like your first mortgage, second mortgage, if you have an equity line, taxes, homeowners insurance, things that need to get paid. Your vehicle expenses are going to be important. Your rent, utilities, HOA fees, insurance, your phone. Second is going to be food, one of the prioritizing your needs. What have you been spending? Go back and look at all of your charges to Publix, Winn-Dixie, Aldi, wherever you happen to Target, wherever you happen to do your shopping. Transportation, which is the vehicle expenses. Healthcare is going to be important too, to maintain your health insurance. And then what do you need for your work and school to continue working? Do you need internet access, or do you need childcare? So now we've built the budget. We are looking at it every 60 days and revising it. And we've gotten past that. And so after you have gotten past the first 60 days, and maybe you're back to a more steady employment, steady income, you can go back and say, okay, we're back to normal. How do we get on that path to financial wellness? We're going to need a plan to get back on track. The first thing you have to do is go back and look and see if you have any place where you did not make payments. Maybe you you deferred a couple payments for your mortgage or for your auto loan, or I know student loans don't have repayments that are due until, I think, September 30th. So how can you get back on track? Come up with a plan on how you're going to make payments over those to catch up to where you were. That might mean making some extra payments every month. Set a time frame for, it could be 2 years. If you borrowed from your retirement account, you will owe either taxes that you have to pay over the next 3 years, or you will have to repay your retirement account without penalty. But you need to also think, what is my plan in order to get the money back in? Waiting until the 3rd year and then having to owe a lot of taxes can be very difficult. It could put you into a worse position than you were in today. So you need to get back on your plan, get a plan for handling that. Replenishing your savings account. If you had to go through your emergency fund and you had depleted it, make sure that you have a way to get back to your savings account. You want to make sure that if you do have something like a car repair or a home repair or something that comes out, and maybe it's a deductible for your health insurance, that you have the resources to be able to cover it. And finally, start saving for retirement. The earlier is always the better, and it's going to come up before you know it. But I'd like to share with you, this is a longer presentation, and I'm going to go through some of it today since we have a shortened time frame. But this is really the financial wellness and what we go over, what is having a healthy approach to money. And so the keys to financial wellness are improving your personal cash flow, protecting what you have that's important to you, saving and growing your money, and helping to secure your retirement. So we want to make the most of the money that you do have, and that's going to be saving, spending, and managing your debt. So these are the budget allocations for the typical household. You're going to spend it on, these are some of those necessities that we just talked about: housing, food, transportation, healthcare, and savings. And that's going to be, it could be for insurance, or it could be for pensions too. It's really looking at a retirement savings. So from a standpoint of what most people spend, usually housing is about 32% of your budget. That's kind of about on the top end. Food is 14% of your budget. Transportation expense, 16%. And that's going to depend on where you live. Some transportation may be your car, but if you have a place that's public transportation, yours could be more or less. Healthcare, 7%, and then savings is 12%. So that's a guide. This was from the US Bureau of Labor Statistics. You can go back and look and see, where do you stack up among these? And this is just an average in the typical household budget. Everybody's different. So housing, for one person may not prioritize housing. They may prioritize traveling or something like that. So your housing may be less, but your other discretionary income might be higher. It just means that you've got to be in balance with all of these. And so this is just the recommended budget allocation. So you'll see that, 25 to 35% in housing, food 10 to 15%, transportation 10 to 15%, healthcare 5 to 10%, savings we're going to say 10 to 15%, but I would want you to see you more on that 15% side. And the earlier you start saving 15%, it could allow you to save a little bit less as you get closer to retirement. So saving the most earlier is the better. So some of the good money saving habits is setting aside a fixed amount of monthly income. Using your automatic payroll to deduct. Most companies allow you to send money directly into a savings account or putting money into your retirement account. Saving money from raises or bonuses. If you're just starting out saving and maybe you haven't been contributing to your retirement account, a good way to do it is to start with a set amount of money. Every time you get a raise or a bonus, use that as an opportunity to increase your savings, because you might not notice it as much if you always go up 1% every time that you get a raise, and that will help you get closer to that 15% over time. But something is better than nothing. Making the most of the money that you have. This is about being that smart consumer, talking about increasing your cash flow, shopping around. A lot of us don't always look, we have that impulse buy. I know that we go on Amazon a lot and buy things. So shopping around can help you save some money sometimes, dining out less. And I think you may, over the last few months, have seen, maybe I know in our personal budget, about dining out, that we have not eaten out quite as much and have spent a little bit less on food there. Impulse buying, you're looking at your phone and cable. I don't know how many times we just take an increase, or you have it automatically sent to your credit card or your bank account, and we never go back and look at the bills. So it's a good idea every year to go back, even through your credit card statements and your bank statements, to see what are those automatic payments that are coming in. I know that personally, we had a dog GPS system, and we haven't used it in several years, and I realized we're still getting billed for it annually. So go back and look at everything from the year. Set a time when maybe during the summer when things aren't as busy, where you can sit down and you can actually go back through all of your bills and see what you've been paying for every year. Because I know stuff will pop up and I'm like, oh, I really wanted to cancel that, but I forgot. Look at buying a used versus a new car. Budget for your holidays. When I work with clients, I have them look at their annual budget, not just their quarterly or monthly budget, because if you have a large expense at the end of the year, maybe you love to buy presents for people, make sure that you put that into your budget and set a little bit aside every month. Have a certain savings account that you use only for holidays or for travel or something like that. And so when you're ready to go, you have the money available and you aren't having to use credit cards or go into debt. And then pay as you go. Okay, so we look at an emergency fund, and so that is COVID-19 is kind of the reason why we talk about having an emergency fund. You just don't know what's going to happen. 6 months worth of income is always recommended, but any number of months of income is better than zero. So during this time frame, having at least 3 months saved. And when we look at the emergency fund, it's not necessarily all your income. You can start by looking at those necessities. What were those things that when we did your budget, what did you need to cover this month in order to get by? So if you have at least 3 to 6 months, you're in really good shape and you're ahead of most people. That will help make things like maybe a job change, and it might be a voluntary job change that you've decided, I just don't like my job, I really want to get out of here, I need to quit. If you have a sufficient emergency fund, it gives you some flexibility. Maybe it's to take a 2-week vacation in between it, but having this emergency fund is going to make you feel a lot better about your finances. And using debt wisely. So debt is really a balance between it. And so we say no more than 36% of income. You have to decide what's important to you. So if you go and have student loans because your education was really important, then you're probably going to have a smaller home, and you might have a less expensive car, because all these 3 things need to be in balance. When we go back to that slide that showed here are what the averages are and what people spend in these categories, that's why there's ranges. If having a really nice home is important to you, then you'll spend more money on your home, but maybe you spent less on your car. less on your education, or you don't have any student loan debt, so you can spend more money on your house and more money on your car. And that's what I talk about with students when they're making the decision about getting student loan debt, that this is a balancing act. You have a set amount of money and you have to decide how you're going to spend it. If you use a lot of debt to fund your education, it's going to carry through later. It's going to mean how much you're going to be able to borrow for a house. You may not be able to get the home that you really want, and it's going to be how much you can spend on your car. And once you get out of balance in all of these, you may start ending up using credit cards because you just don't have enough income to cover your expenses. Also understand the impact that interest can have. This is making the most of the money that you have. A lot of people have money sitting in just like a savings account. So we're saying here $10,000, 5 years at 12.5% interest. I don't think you're going to get, oh, this is for paying interest on your credit cards. So 10 years at 5 years at 12.5% interest means that you're paying 13.5% or $13,500 to pay it off. So that's a really, actually for a credit card, that's a pretty low interest rate. Most of the credit cards that I've been seeing with clients have been between 20 and 30%. So you can't imagine how a $10,000 debt suddenly multiplies when you use credit cards and you only make the minimum payment, because you're never gonna crack through a significant portion of the principal. You're going to continue to pay some pretty high interest rate. And so manage your debt, take inventory of what you have. Some people don't even realize how much money they have. Pay down, pay off, consolidate your debt when possible. Really take a look at those credit cards and see what the interest rate is. Most people can't tell me what they're paying in interest. They know what their minimum payment is. They know how much they've been paying. But when you get down, look and see what was my monthly interest that I paid this month, and then add it up across all your credit cards and all of your debt and see how much you're paying in a year. You might be really surprised. Try and consolidate them. Sometimes there's a 0% financing that if you can commit to it and not use your credit cards and actually pay it off over time, that's a good route to go. You can refinance it. You can, there are other places that loan to consumers for a less interest rate than credit cards and don't allow you to continue to increase it, but also monitor your debt. Pull your credit report every year at least. Look at it and make sure that what you owe is what you think that you owe, that there's nothing, that you're allowed to do it through the government website that allows you to do that, but monitor it to make sure that there haven't been any significant increases in it that you didn't know about, or maybe there's something that you forgot about, and maybe you moved and the bill didn't follow you. So take a look at your debt to make sure that it's what you expect, because your debt will also impact your ability to borrow money, and it can end up costing you for a long period of time. So we're improving your personal cash flow. One of the things we did was building a better budget. Really understanding your budget helps you build a better budget. You can look at it and say, I didn't realize I was spending that much money on dining out. I'm not getting as much out of it as I thought. Maybe there's a better way that I can spend my money. Or I've been to Starbucks quite a bit. That's not where I want to spend my money. Saving first is easy. Whatever's left over is what you can spend. That be a smart consumer and using your debt wisely. Okay, and so things that are important to protect your property. Make sure you have adequate homeowners, auto, personal liability. Rebuilding costs may not be what the appraised value is of your home. So check that out. Work with your insurance agent to find out what the right level of homeowners insurance, if something happens in terms of a catastrophic loss, in terms of fire or a hurricane or something like that, you want to make sure that your house is adequately covered. Health, including medical, long-term care. There's insurance that can help you with that. Disability, your income is probably your biggest asset that you have, and it's your ability to earn money. There's different sources from disability insurance. It could be through an employer benefit. You may or may not pay for it. You may have the ability to elect short-term, which is usually for 6 months or less, or long-term, which can go all the way up to age 65. Whichever you choose, whether to go with an individual policy or one offered through your employer, make sure you understand the terms and conditions of it. They usually have limitations on how much they'll pay off each month, how much they'll cover, and whether or not it's going to be your occupation or any occupation. Life insurance, that's for the ones that you might leave behind in an accident or illness, and then identity, protecting your identity too. Protecting your health, income, this is about the disability insurance. Could you live on 46% of your income? And that has to do with group disability. So, this talks about life insurance, the benefits of life insurance. It helps pay off final expenses, pay off debt, replace income, leave a legacy, and plan your estate. This is life insurance. People have a misconception that it's only for people who are married, and that's not necessarily true. If you have, if you're single, you probably have a family member who is going to take, be responsible for your final expenses and settling your estate, and so you might want to leave them some money to be able to help pay for some of those expenses if you don't have the assets to cover them. And it might be that you have children, or you get married, or you have other dependents later on, and you want to make sure that you can lock in your insurability, because insurance is based on your health and your age. And once your health you are uninsurable, you're going to have a difficult time getting insurance. So that's just something to think about. And that's estate planning. And I've had a lot of calls about estate planning recently. Make sure your PINs, passwords, account number, credit report help secure your identity. Let's see. Okay, so how can you make the most of your savings? Starting early, setting goals, think long-term, and put your money to work. Earlier the better. First job, even when you're 16, you can start saving for retirement. My son's started working at Busch Gardens last year, and he qualified for their retirement plan, so he immediately started saving for his retirement. It's not a whole lot, but he's got a long time to go before he's going to be able to retire. So it's got a lot of time for growth. Just like set goals, doing the saving first rather than and then spending later. Think about long term. I know for somebody in their 20s, the retirement seems like it will never come, but it will be here sooner than you expect. And the longer you wait, the more you're going to have to save. These are the different types of savings that you can use. It's from cash alternatives, which means like CDs, think of bank deposits, all the way up into stocks, which you might see in your retirement accounts. Let's risk. Just talking about compounding interest, that if you saved $6,000 of gross income per year for 20 years with no interest versus 8% average annual interest, it would grow from 120 to 296, 538, and that's a 20-year time frame. If you're in your 20s, you have even double that before you're going to be retirement. So you can see what a difference it makes to start earlier. Be savvy about your saving for retirement. Make sure you understand the tax advantages of IRAs and your 401k plan. Take advantage of any type of matching contributions from your employer. And look at rolling old retirement accounts into an IRA. You can speak to a financial advisor and they'll be able to help you evaluate the different options. So save and grow, start early, set goals, think long term, and put your money to work. And then helping secure your retirement. This talks about like pensions and lifetime income. Social Security is also a type of pension, essentially, where you're getting paid throughout retirement. Defined benefit plans, part-time work. This is how income sources once you're in retirement. So let me go through a few of these. So like when you're in retirement, there's certain risks. You have longevity, inflation, public policy, healthcare, and investment risks. So these are things to consider as you're working towards retirement. You have the accumulation phase while you're working. Once you decide to hit retirement, you're in the distribution phase. So your retirement income strategy changes just a little bit once you're retired. And you have to think about all of these different things and how to mitigate some of them. So I'll just talk a little bit about Social Security, maximizing Social Security benefits. If you're approaching retirement, waiting to claim benefits, you have age 70 is going to be where you get your maximum benefits. It doesn't help you by waiting any longer. Full retirement age is going to be on your Social Security statement. I encourage everybody to check their Social Security statement to make sure that it's been accurately reported. I just had a client recently and there was a year that was missing from her Social Security statement, and that can impact your benefit. Let's see. Okay, so this is the recap. We talked about improving your personal cash flow, and we did that over the last 3 sessions. Protecting what's important to you, and that means using insurance. That could be for life insurance, disability insurance, long-term care insurance. Saving and growing, that's going to be it could be in a savings account all the way up into other investment accounts. And then securing your retirement, that's more about once you hit retirement and making some decisions about how you can make sure that you have the ability to live the last day in retirement in the same way that you did the first day. So that's all that I have for you today, and thank you so much for attending, and I will put up my contact information. Feel free to reach out to me if there's any questions that you have or if there's anything that I can help you with.
Thank you so much, Lori. I really appreciate that. We do not have any questions from the audience.
Okay.
Bethany did an amazing job. So I want to say thank you one last time. And of course, please put any questions that you do have in the chat function, or you can feel free to contact us at hcplc.org, and we will be happy to answer those questions there. Thank you again, Lori. Hope you have a great day.
Thank you very much. Bye.
Bye.